Hi everyone, welcome to my YouTube channel, and today we are discussing shares. And shares have another name in stocks or equities. And I want to say that shares can be broadly categorized into two. One is preferred shares, what we also call preferred stock or preference shares, and the other category is common shares, what is also referred to as common stock, ordinary shares, or voting shares. When you buy preferred shares of a company, what you are promised in return is a fixed rate of dividend. And of course, there are many different types of preference shares, which I don't want to discuss now. But of importance to say is that when you buy preferred shares, they do not confer ownership rights on its owners, so that you cannot claim ownership of a company simply because you bought preferred or preference shares. And they are also non-voting, so you cannot purport to claim that you want to take part in the way the company is being run by owning preference shares, because they do not give you the rights to vote on company matters. But our discussion today, I would like it to focus on common shares. And a common share is an ownership interest in a business. So that if you bought shares of a company, then you become part owner of that company proportionate to the number of shares that you've bought. For example, if a company raised equity capital by issuing 1,000 shares, and you bought 100 of those shares, then your ownership stake in that company becomes 10%. It's also important to know that when you buy shares of a company as a common shareholder, then you partake of the good and the bad of that company. So that if the performance of a company is supernormal, you partake of that good time. If the company is ailing, you also partake of that bad time. So it's important to really know that being the owners of the company, you have what we call a residue claim on the assets or any distributions that the company makes. An example is to say that if a company were to go bust or be liquidated, they will first pay other claimants. That is to say, they will pay other liabilities that have claims on the assets of the company before they pay you, because the first or the highest priority claimants are secure debt. Then we move to unsecured debt. Then we go to preference shares. And on the bottom of the food chain is you, the common shareholders, because then you are the owner of the company and you partake in the bad and the good times of the company, while the rest of the providers of capital do not partake in the good times of the company. And so also when the company is bad, they do not partake in the bad times of the company. What they have are promises. For example, we said for bond investors, they are promised periodic interest, and upon maturity of their debt, then they get repaid their principal amount. And these are legally binding. These promises are legally binding. But for the case of equity or common shareholders, you realize that the company does not commit to repay you back. We said that. And also, it doesn't commit to make any distribution to you either through income, because it's not legally binded to do so. It's also important to know that shares don't have a maturity date. They're issued with an infinite life. And I would also like to say that common shareholders have voting rights. If you own a common share, then that common share could be equivalent to one vote, such that you can decide who the senior manager will be that will run the company, or whether a company merges, acquires, or takes over another one. So those are decisions that need your vote. So by owning common shares, you have a say on how the company is going to be run. And it's also important to note that you're also entitled to what we call cash flow rights. That means anytime a company makes a distribution, okay, remember we said that dividends are discretionary. They are not legally binding. But it's in the interest of the company to make distribution to its shareholders, especially when it has made enough profit such that it has excess capital That is after it has retained some for working capital and for investing in fixed capital to make it a going concern. After it has done that and still has excess cash, it can distribute that cash to you, the shareholders. And when it does so, then we say at that point you have a right to cash flows, meaning that whether you own 1 share or 1 million shares, then you be guaranteed that you receive some distribution in proportion to the number of shares that you earn. But remember, dividends are discretionary. Some companies issue dividend, some don't. You find some company increasing their dividends, some cutting their dividends, some stopping paying dividends altogether. But the most important thing is to know that dividend payments have what we call a signaling effect, such that companies that issue dividends most of the times will see their stock prices rise as compared to companies that do not. So it is in the interest of the company to issue and even increase dividend. So another thing I want to say is that when you buy shares appreciates in value. You can buy a share at 5 shillings and after 5 years it goes to 30. So the difference, which is 25 shillings, becomes your gains. And these gains, we call them capital gains. And capital gains can be unrealized if you haven't sold, or they can be realized after you've sold. So remember that unrealized gain are paper wealth, which can disappear depending on how the stock prices are fluctuating. But the moment you sell, you make it realize, and it's real wealth now in your pocket. So it's also important to know when to buy a stock, at what price, and even when to sell, so that you also don't hold overvalued stock that will fall in price and destroy your wealth. So it's very important also to note that for you to begin investing in stocks, you need to have a CDS account with a brokerage firm, and these firms, you can find the approved one in the website of Nairobi Securities Exchange. And even some of them nowadays, they provide online trading or platforms, even in your phone, where you can just, at the comfort of your home, you can place a buy or sell trade. But remember, shares are riskier than bonds, and before you invest in them, please hold a long-term view, because in the short run, then the prospect of high returns from stock may remain unfulfilled. So it's very important to note that you can't use your school fees or a child's school fees due in the next few months to buy stocks in the hope that you reap big when you sell your shares. So very important to note that. So for any young person, I encourage start owning shares now. Of course, shares of good company, well diversified, and hold a long-term view. And if you find difficulty in doing this, please work with an investment advisor, a financial advisor or consultant who can hold your hand and try to really help you achieve your long-term financial goals by investing in stocks. So thank you very much for listening, and see you until next time. Thank you.